Welcome to the Islamorada Investment Management Annual Investor Meeting for 2017. It is October as I'm recording this now. The original date for this meeting got pushed back for a couple of reasons. The big one being we were finishing up construction in our new office this spring. And then, the even bigger one more recently, Hurricane Irma blew through town. I'm just going to specifically avoid talking about Hurricane Irma today. I'll just point out that because of the time of year we're doing this, you're all sort of getting a twofer in these slides. We'll walk you briefly through 2016, even though it seems like a long time ago now, and then we'll get you up to speed on 2017 so far too. So here we go. This is our standard disclaimer. It's about as long as I'm going to pause on this today. Here's the agenda for what we'll be covering. You are watching video 1. Also in the same video, talk about Gecko briefly, go into detail on Tarpon at the portfolio level. Video 2 is Rhett's, Loretta Reeves here on international investing. Video 3 is me on oil. Video 4, do some Q&A on lower for longer in the oil market. Video 5, going to be a Q&A on debt at Tarpon companies. And then there is also a PDF file that contains written answers to other questions that were sent in. The answers to most of those questions in that PDF didn't really lend themselves to graphics like the other two Q&A sessions did. So written responses seem better for those. You don't have to view these videos in order or all at once even. If you want to hear from Rhett's, you can jump directly to that video number 2. I also have a transcript posted for videos 1 and 3. This intro, including Tarpon, and Gecko comments, and then everything on oil too. So you can download and read that PDF transcript if that's more convenient than watching the videos. I believe we've answered every question we've gotten to date. Some of those questions were addressed sort of in the natural course of the planned presentations, and others were more explicitly discussed as part of that PDF and in videos 4 and 5 there specifically. But let us know if we missed any, and otherwise, as usual, please let us know what other questions you may have after watching these presentations too. So let's get into it. Compared to Tarpon, Gecko has a far smaller number of investors and assets, so I'm going to sort of size my commentary appropriately here. Gecko, you may remember, is the equity income portfolio that I manage here, which emphasizes dividends and distributions more than growth per se. In certain times, though, in early 2016 was one of them, we can buy companies with very attractive yields and the potential for excellent capital appreciation too. We had a very good year in 2016, returning just under 60% for the year in Gecko, net of fees. And the current yield of Gecko is still really attractive at just under 7%, also after fees, and that's as of this past Thursday. Over the last year and change, we've seen 2 of our Gecko companies get acquired at nice premiums. Pentex Midstream Partners, PTXP, which I'll talk more about in a minute, as well as JP Energy Partners, JPEP, which was actually bought out by another company we owned in Gecko, American Midstream Partners. So not only did we see some excellent appreciation on those shares, or really units, they're called in this case, but because that JPEP buyout was a unit for unit deal, and we kept most of our position in American Midstream after the deal, our effective yield on those original cost JPEP units will continue to increase. Gift that keeps on giving and whatnot. Gecko is not as directly tied to oil prices as Tarpon, but we do own a number of securities that are in that energy sector. MLPs, Master Limited Partnerships, that I'll get into here. And so Gecko has not done much in terms of capital appreciation so far in 2017, largely due to the same oil price malaise that has impacted Tarpon, although that yield on Gecko has remained solid. Quick refresher on MLPs. Again, in Gecko, we own a number of master limited partnerships, or MLPs, and most of those are pipeline companies which move oil, gas, and liquids around the country. But because MLPs issue K-1s at tax time every year instead of the usual 1099, I limit Gecko to just taxable accounts, so no IRA or tax-deferred money in Gecko. Owning Gecko in a tax-deferred or IRA account can cause headaches with the IRS when it comes to something called UBTI or unrelated business tax income. And because for whatever reason these MLP companies can't seem to get their K-1s out before April 15th every year, that can be annoying for some folks too. For some folks and their CPAs, I should say. Still, though, I feel like those inconveniences are worth it. For those of you who haven't spent much time investing in the master limited pipeline area in that sector, it is a great place to find inefficiencies in the market because so many investors assume that you evaluate these companies the same way you would a more traditional or more regular C Corp. Really, though, those MLP capital structures are often built more for tax efficiency, leverage, or operational flexibility. So as a class, they end up with certain misconceptions and misunderstandings around them. But if you combine that unique structure with the fact that many investing institutions are restricted from buying partnerships, whether by prospectus or by law, then in the end, MLPs are just sort of one of those underfollowed and inefficient parts of the market that can well be worth the time. If the supply of oil, NGLs, natural gas liquids, or natural gas in the basin or region a pipeline is located in exceeds the takeaway capacity, then you've got a true toll booth of a business. If supply is less than takeaway capacity, even just a bit, then you'll see MLPs compete with each other and drive each other's revenue down. So pipelines can be excellent businesses, but I also wouldn't be indiscriminate or tempted by every attractive distribution yield you see, by any means. And I guess I say that specifically because the marginal costs for these guys are effectively zero, which means that they view unused pipeline capacity as almost criminally wasteful. So you'll see competition crimp things a bit in certain regions, at least until there is a bit more balance between supply and takeaway capacity there. In any case, the uncertainty in the oil market hurt the MLPs in Gecko in early 2016 when oil hit $26 a barrel, but it also opened up some really head-scratchingly good opportunities if you didn't let yourself get too caught up in the panic. That panic around 26 created some truly amazing opportunities in the market, even among companies like MLPs that don't have exposure to spot prices. I want to hit two quick examples of that we saw in Gecko, and really because I feel like right now Tarpon is also full of opportunities that seem almost too good to be true, at least to me, and after the panic and fear goes away, you'll find out, yeah, it turns out these things really are true, kind of like we did with Gecko. So on the first bullet there, slow motion buyout with a big margin of safety. And that was when Pentex got acquired. Pentex Midstream Partners was acquired by Energy Transfer Partners, or ETP, in what was just about as unsurprising a buyout as I can remember. Nonetheless, we still earned about a 47% premium on our shares, plus we got an attractive yield on Pentex in the slightly over a year that we owned them. And I say it was not real surprising for a number of reasons, including the quality and rarity of their assets, attractive cash flows, etc. But really it shouldn't have surprised the market because ETP, Energy Transfer Partners, already owns 65% of Pentex, and Energy Transfer owned 100% of Pentex's general partner. So, already there was either clearly going to be takeout potential or, in the worst case, it was just good, big confirmation from a knowledgeable buyer that Pentex was very undervalued. Energy Transfer made a standstill agreement with Pentex until May of 2017, meaning that Energy Transfer was not going to be able to buy any more shares of Pentex prior to May of 2017. And then ETP was really signaling just about as clearly as you could without sort of hiring a skywriter that it made no sense for them at all to do anything other than buy out the rest of Pentex at some point. So you can probably see where this is going. In the middle of May, as soon as that standstill agreement expired, sure enough, Energy Transfer bought the rest of Pentex. It seemed sort of obvious and relatively easy, yet I never really read or heard anything about it other than the work I kind of did myself on it. And I think that was really because most investors are too busy at that time just fretting about oil prices. Second bullet there, nearly doubling our money and still earning 19% a year. And that relates to Crestwood Equity Partners, or CEQP. So Crestwood announced a 1-to-10 reverse split in November of 2015, and shares started falling further right after that, both because traders don't like reverse splits or something, and then oil was also on its way to 26 bucks a barrel. As near as I could tell, people got so panicked that they just couldn't multiply 55 cents by 10 because the annual distribution on Crestwood was solid, and the post-split distribution of $5.50 on a share price of $12, which is what Crestwood shares or units traded down to, that was just sort of bonkers. But there it was, staring us in the face. So we bought a bunch of Crestwood between December of 2015 and April of 2016, and through market close as of 2 days ago, I believe, on our cost basis of $12.72 per unit, we've seen capital appreciation of 90%. But wait, there's more. The yield on Crestwood today is 10%. The yield on our shares today is 18.9%, and that yield is solid, and it will grow. So the point is that if I told you in February of last year, where everyone was sort of pulling their hair out wondering about oil prices, that we would buy something that would basically double in a year and then would soon be paying us 20% a year forever after that, as long as we held it, you'd probably have thought I lost it. So my point is really this. It's only fear in the market that creates real opportunities, full stop. And you're not going to read about any of those real opportunities in the newspaper or see them on CNBC, at least I never have. But if you have a good process and you do the work and you keep plugging away and you just stay calm and above all just be patient, then the results should eventually take care of themselves. So even if shares like those of Pentex and Crestwood can be so stunningly volatile, I mean, these companies had no exposure to the stock price of oil, had secure and growing cash flows, they're well hedged for years, they had no liquidity issues, basically own brand new assets. Just imagine how mispriced things can get in companies that do have a little bit more direct exposure to oil prices, which brings us to Tarpon. So if long-term growth and not yield is the primary objective, Tarpon is a superior alternative to Gecko for the foreseeable future. Calendar year 2016, Tarpon was up 107% after fees. Our 2016 performance was excellent, and in the bigger picture sense, it was also a good look at how inefficient the oil market is these days. More specifically, 2016 was notable in that we had 2 10-baggers in Tarpon. 10-baggers are stocks whose share prices went up more than tenfold or more than 1,000%. We still own all of our shares in one of those 10-baggers, Resolute Energy, or REN, which has since come down a bit from its highs earlier this year, but which I think is still worth considerably more, so we're hanging on. And the other 10-bagger, Clayton Williams, CWEI, was actually acquired earlier this year. That was a little bittersweet in that I was hoping we'd see continued gains there as oil kept rising the next few years. But, I really can't complain. We took that profit from Clayton Williams and redeployed it elsewhere in Tarpon this spring. So in 2016, we had a banner year, but at this point, it's also old news. And as much fun as 2016 was, 2017 has been an exercise in patience and then some. Our performance from the first of the year through the end of September 2017 in Tarpon was a negative 31%. This has been a long, frustrating year so far, and it's all about oil. The fundamentals, the actual data is unequivocally positive, and I will get into that in much greater detail soon. But sentiment is excessively bearish. The good news is that data will rule in the end, and we're close to the point where good data is going to be impossible to overlook soon. Again, I'll talk a lot about oil more soon, but let's stay focused on Tarpon a bit longer here. Executive summary. Here's an executive summary version of the next parts of this presentation in 3 questions. First, what went wrong in 2017 in Tarpon? I utterly failed to predict the sentiment shift in the oil market. Second question, how are we picking these stocks? We are focused on capitally efficient shale oil producers with good management that can survive lower for longer and have significant torque to oil prices. Final question, how do I intend to fix this? This will take a little bit more explaining, but let me get into it. The data would suggest that there is not a lot of support at all for the high level of bearishness that is currently out there in the oil market. And again, we'll get to that. In fact, this is going to sound a little surprising probably, but we are now in a bull market for oil. You just certainly wouldn't know it if you look at oil prices today. I strongly believe that with the continuation of big drawdowns in U.S. and global oil storage inventories, we're going to soon see a big shift in sentiment in an oil price that better reflects reality. And while it's frustrating to be unable to identify ahead of time when exactly that shift in sentiment will get here, we're staying long and grinding it out here because the cause of that inevitable shift is probably only going to be visible in the rearview mirror anyway. The more inventories drain, like they are now, the higher the likelihood is that that shift is imminent. So, if you can't tell, I'm trying hard not to sound too cavalier here about my answer to that how will I fix this question. But the good news is that we simply don't have to do anything to correct this underperformance this year. This is a problem that will self-correct, specifically because U.S. oil production is falling way short of what Wall Street and the three main international reporting agencies had previously forecast. And I'd also remind you that this is not a basketball game, that there is no 24-second shot clock. Relative to the size of gains that we should see, these months of frustration that we're going through right now are not going to matter in the end. In a minute, I'll show you some slides about the expected future returns in Tarpon that underscore why I think we will be so well rewarded for our patience. So that's the short or the relatively short version of everything that follows in this section. Let's dive a little deeper into Tarpon. I didn't get took a little sip of water there. I didn't get a single question before the meeting this year about any of our individual companies in Tarpon. That's probably a good indicator that I'm focusing too much on oil and not enough on our companies. When I write my quarterly updates to y'all, I'll try to fix that in my next few letters. In the meantime, it does kind of give me a chance to talk about Tarpon at the portfolio level instead of the company level, which I do pretty infrequently, and I think you might especially appreciate that right now. So, this may look like a pretty simple table, but there's a lot going on behind the scenes. At a high level, what I'm showing you here is the returns that we could, in theory, expect out of Tarpon, given the portfolio's correlation to the two big variables involved. So the first point I'm trying to make here is that we have a rare chance to earn large asymmetric returns here in Tarpon. Okay, now what do I mean by asymmetric returns? I mean that in the statistical sense, the distribution of our future returns is heavily skewed towards large positive numbers. Or, more simply, we have orders of magnitude more to gain than we stand to lose. So it's not that there is no downside here. We're sort of living it right now, I think, really. But it's that the downside is both limited and dwarfed by the potential upside. Which, if you step back, makes at least a little intuitive sense, I hope. Oil can be awful volatile, but the price is also never going to go to zero, right? I mean, contrast that with something like Radio Shack, where their revenues are probably going to be indistinguishable from zero before too long, if they aren't already. I haven't really checked. In a table like this, more than half of it would be full of big negative numbers. So there are certainly risks in owning E&Ps, but obsolescence is not one of them. And when you're buying in the bottom of a cycle, assuming you have full transparency, the profile of your future returns looks much more appealing, like this. Okay, so let's look at this table. We've got a number of different WTI oil prices across the top there, from 40 to 45, all the way over to $100 a barrel on the right. Now, realize that no producer actually gets to realize exact WTI price in selling their oil, and not all of their production is exclusively oil-based. There's some liquids and natural gas in there. But this table is an illustrative exercise. I'm ignoring things like pricing differentials and production mix here because I'm really after rough accuracy and true precision just isn't practical. In that left-hand column, running vertically up and down there, in the column labeled EV to EBITDA multiple, that's the other big variable that's going to determine our returns in Tarpon. Specifically, it's the valuation of our companies. EV stands for enterprise value, which tells you how much the market believes a whole company is worth. It's similar to market cap, only includes the value of debt a company has outstanding too. So if you're going to buy a whole company outright, you would pay its enterprise value. EBITDA stands for earnings before income, taxes, depreciation, and amortization, but you can think of it as a rough proxy for core cash flow here. Now, there's a whole other slideshow we could do on the pluses and minuses of using EBITDA and valuing companies and why you really shouldn't consider it equivalent to actual cash flow and how EBITDA margins might be impacted by a number of other variables. But I'm using it here in spite of some reservations because it's the simplest way to do this sort of table, and also because, frankly, it's a pretty popular metric among E&Ps, flaws and all. So this table shows what the future returns of Tarpon could be, in theory, at a number of different oil prices and at a number of different valuations. For instance, if you think WTI will be at $55 a barrel, and that our companies on average deserve to trade at an EV to EBITDA multiple of 7x, then Tarpon has an expected return of 127% here, as measured from about a week ago when I last updated all the numbers here. Behind the scenes, the expected return numbers in this table are linked to a number of different valuation multiples for each individual Tarpon company we own, as well as those different oil prices. And then those expected return numbers also already reflect the actual percentage weightings of each holding we have in Tarpon 2, again, as of prices a week ago. So all in all, it's a pretty good proxy of real-world sensitivity. To be clear, in Tarpon, some of our companies are absolutely more sensitive to oil prices than others. Typically, you'll see larger variability in a company's EBITDA the more oil it produces compared to gas or other liquids, as well as compared to operating costs on a per barrel of oil equivalent basis, for instance. So when I talk about owning companies that are geared to oil prices, that gearing is really related to a higher oil mix and higher operating leverage in the business. And then, as we'll discuss in one of the separate videos later on, if you add financial leverage to the equation in the form of some but not too much debt at the company level, then you can get this Lollapalooza kind of effect in returns as oil prices increase. So where oil prices will be is one question I tried to address in this table, and so is the question of the appropriate multiple the market should assign to U.S. shale oil drillers. The two are not necessarily independent. Higher crude prices mean higher valuations, just as lower crude prices mean lower valuations. On the appropriate valuation levels, by way of contrast there, the average EV to EBITDA multiple of 5 of the biggest Wall Street darling shale oil companies, as per that note at the bottom, none of which we own, the average valuation multiple is over 15. I cut this table for our guys off at 10x just to keep it conservative, but realize that almost all of our companies operate in the same oil basin that those 5 Wall Street darlings do. So all things being equal, our guys arguably should merit a valuation multiple a lot closer to 15 than 4, especially if when you look at your front porch, you're surrounded by other 15s. Well, it seems like there might be a little room to earn a higher multiple, I suppose. In any case, in the very big picture sense, when I say or when I write things like "hang in there, it'll be worth it," this table is the core of what I'm getting at. And while I'm not real pleased with being down like we are so far this year either, in the context of these possible future returns, this current lousy period we're in will end up, I think, being a small bump in the road. If oil gets back to $100 a barrel in a few years, you can bet the market will also reward these guys with a multiple much closer to 10x or above, in which case our returns will, in theory now, Be pretty spectacular. And even though our expected returns here are also pretty asymmetric already, as per this table, the reality is if that data starts coming in that indicates that oil might in fact stay at $40 or $45 or even $55 a barrel for a long time, we would be out, hopefully long before those negative returns in the upper left quadrant there show up in Tarpon. So if I were forced to come up with a forecast for oil prices and then translate that forecast into what it might mean for Tarpon, here's how that would shake out. Assuming oil gets to $60 a barrel in the second quarter of next year, our expected returns would be theorized by the shaded purple cells there in the middle of the table. If oil reaches $75 a barrel a year after that, see the purple shaded cells again. And then finally here are our theoretical returns when we finally see the supply shock arrive in that first quarter of 2019 and oil spikes. Hope all that makes sense. Probably a very long-winded way to say, please just stay patient, folks. Now let's talk a little bit about break-evens. These are another couple slides that I think should either directly or indirectly answer a few more questions about Tarpon. Look through acreage and break-evens. This table shows the acreage owned by our oil-producing companies in Tarpon on a portfolio-weighted basis. Some of our companies are pure plays, meaning they own acreage in just one oil basin in the U.S., and some own acreage in several different areas. Next to those acreage numbers are the oil break-even prices for that acreage, as published by a third party. So I'm not just taking the company's word for it here when it comes to what they think their break-evens are. And there's, incidentally, there's more at work than just operating costs in those break-even numbers here too, but that's probably a whole other discussion. The cells in this table that are highlighted in orange represent where the company is either currently drilling or will drill. That is where, then, they are exclusively focusing their drilling efforts for the foreseeable future. So, as per the second part of the same table, again, same companies, just additional acreage. Table was too long to put in one slide, so I split it up. Even though a few of our companies own a little acreage here with break-evens in the low 50s, they aren't drilling it. There are no orange cells in this whole half of the table. So, on a look-through basis, if you categorize the acreage holdings of all of our companies in Tarpon, weighted by our position sizes, here is the distribution of break-even prices we're looking at. 84% of the total acreage our companies own is economic to drill, even when oil is between $38 and $45 a barrel. Lower than $38 a barrel, well, then drilling stops. Between $38 and $45, we will earn an internal return of 15% on each well drilled, on average, at the company level. And when WTI oil prices are higher than $45 a barrel, like now, our company's internal returns on new wells start increasing rapidly. So to be clear, this is still different, though, than where our companies are actually drilling right now. This is just all the acreage they have. Here, though, is where our companies are drilling now, and where they each have enough inventory to keep drilling for the next 3 years at a minimum. The majority of the acreage we own has a break-even of between $38 and $40 a barrel, and all the rest has a break-even of between $40 and $45. There is no need for our guys to drill anywhere else. And as oil prices rise past $45 and higher, then again, the internal returns these companies can earn on drilling new wells become significantly higher. Tarpon has the most look-through acreage. If we're to look through our portfolio, assume we own a piece of all that acreage just like our companies do because we own small pieces of them. Tarpon has the most look-through acreage in the Permian Basin in West Texas, which is the most prolific oil play in North America. our emphasis on the Permian and then secondarily on the STACK and the merge plays in Oklahoma mean that even if I'm way off on my own thoughts about oil prices rising significantly here, and if oil stays stuck at 45 bucks a barrel for a few more years, our guys will survive. The point is, none of our E&Ps need to see $60 oil to survive. I should point out that one of our recent portfolio additions this summer is not an E&P, and that company, Ensco, owns offshore drilling rigs that are contracted by the big oil companies. The big driver of their earnings, day rates, isn't driven as directly by oil prices as much as it is tied to utilization rates. And it'll probably take utilization rates crossing the 80% level again before we see a step change increase in Ensco's earnings. And that will likely be at oil prices closer to 70 bucks a barrel than 60. But the company's big backlog also makes them somewhat immune to lower prices in the near term here, so all in all, and especially given Ensco's valuation, I'm willing to wait. In any case, the point is that our companies can make things work at today's oil prices. They're not going to make a lot of money if WTI gets stuck at this recent 50 bucks a barrel for a long time, and neither will we. But one, that's highly unlikely for reasons I'll get to in a bit, and two, you really don't need to lose sleep wondering what will happen to our companies if oil stays stuck for lower than expected or for longer than expected either. We own the best rock and have the lowest break-evens, in all of unconventional North American oil production. Again, we do not need high oil prices to survive, although we're obviously looking to do more than just survive here. You know, in the words of the irrepressible Irish pugilist Conor McGregor, we did not come to take part, we came to take over. All right, lowering the testosterone here. Finally, on our companies as a group, I think it's important to point out that stability in oil prices, even at 50 bucks a barrel, makes things significantly easier on our guys than volatile swings. Our companies are seeing higher margins this year versus last year and are that much closer to free cash flow if they aren't there already. So even at 50 bucks a barrel, EBITDA will improve, making their valuations that much more attractive. Higher volumes from our companies also means lower per unit cost, lease operating expenses most likely, plus G&A in most cases, and that means wider margins. So valuation multiples for our guys right now are in many cases less expensive than they were last year. Even though I expect service costs to increase for U.S. E&Ps, it's worth, I think, pointing out that higher service costs do not necessarily mean lower margins. They could if they weren't offset by efficiencies, but again, we're already emphasizing that in the companies we select for Tarpon. So lower oil prices do mean lower margins, but higher production volumes do also help with costs. And again, margins are a function of price versus operating costs, not capital costs, like when it comes to oil field services. That in particular is a pet peeve of mine when it comes to one of the bears' arguments these days. So I feel like it's worth bringing up. The last bullet there, our average company size in Tarpon is skewed towards the small cap end of the spectrum for sure. That's because that's really where the value is. But it's also worth pointing out that as smaller companies like ours grow, as oil prices rise, their operating costs come down on a per unit basis. That increases their internal economics and metrics like EBITDA per barrel for the same given price. And then as they move from small company to big company, the IRRs, the internal rates of return on their drilling efforts, can get a boost because those operating costs become stretched over more barrels too. Look, an E&P is a reinvestment business. I'm gonna take barrels of oil out of the ground, convert them to dollars, keep some, and then put the rest of the dollars back into the next well. Rinse, repeat. I want to do that because I can get some really impressive internal returns in certain parts of the oil cycle, like right now. Over time, I also want to do it with increasing efficiency. If I can do that, then I can grow, and my cash flows should grow even if oil prices are flat, because the costs are being spread over a bigger production base, up to a point. So we focus on smaller names that can grow and expand margins, even if prices are flat or down a bit. All of which is a really long-winded way to say there are multiple levers our companies have to ensure that we are maximizing our long-term compounded returns coming out of the cycle as oil prices increase. And in the end, what do we really want out of our companies? We want three things, right? We want higher pricing surprises above the strip. We want improving free cash flow. We want more efficient capital growth. We have number three. We are seeing number two, and in video number 3, we'll talk more about that first one, oil. But now, let's let Reds talk about international investing.